Ever wondered how to value a growth stock, or how to make sense of this chaotic, unpredictable world we live in? As we plunge deeper into the intricacies of the financial world, we realize that the importance of growth stocks cannot be overstated. These promising entities offer potential for significant earnings, a glimmer of order in this otherwise chaotic life. However, identifying their true value isn't as simple as it appears. We need a methodical approach to navigate this process because, let's face it, we all crave for some semblance of order in this chaotic life. That's why we'll introduce you to steps to value a growth stock, because who doesn't love a good step-by-step guide to navigate through this unpredictable world? So, are you ready to navigate this exciting and terrifying terrain? Stay tuned to discover the 10 steps to value a growth stock, or how to make sense of this crazy world, whichever comes first. First things first, understand what a growth stock is. It's like trying to understand why we all exist, but a bit easier. Just like life's mysteries, a growth stock is a bit unpredictable, but let's unravel its secret together. A growth stock is essentially a share in a company on the brink of outshining its peers in the market. Now, don't expect these stocks to pay dividends. They're like that rebellious teenager that doesn't conform. The reason? Well, these companies are akin to a passionate artist, pouring all their earnings back into their craft, or in this case, accelerating their growth in the short term. Think of a tech startup on the verge of a groundbreaking discovery. They'd put their earnings into research and development rather than sharing it with you. Might be wondering why you'd even consider investing in such stocks. Well, the answer is simple, because who doesn't love a good gamble? The potential for high returns is as enticing as hitting a jackpot. If the company outperforms, the price of the stock can skyrocket, giving you a handsome profit. But hold your horses. Just like life, with high reward comes high risk. Growth stocks are often more volatile than the average stock. They're like a roller coaster ride. So, growth stocks are all about capital appreciation. The goal is to buy the stock and later sell it for a hefty profit, or potentially lose everything. It's a thrilling game, isn't it? Now that we've decoded what a growth stock is, let's move on to understanding how to value it. Kick off your analysis by scrutinizing the company's earnings. Think of it as trying to decipher your partner's mood swings. Let's start with the basics. 1. When we mention earnings, we're referring to the profit a company, to put it simply, it's what's left after deducting all the business expenses from the revenue. Consider it as your monthly salary, just with a few more zeros tacked on. 2. The significance of earnings lies in their ability to offer a clear picture of a company's financial health and potential for investment. Think of it like checking your bank balance before deciding to paint the town red. 3. Unraveling the mystery of earnings isn't about focusing on a single figure. It requires a keen observation of growth and consistency of earnings over time. You could liken it to tracking your weight loss journey, but with a less disheartening outcome. And remember, earnings are the foundation of a company's value. It's time to gear up for step 2, or as I humorously refer to it, the next level of this financial horror game. Next, evaluate the company's revenue growth. It's like watching your child grow, but with more numbers and less tears. Now, this is a pivotal step in valuing a growth stock. Why? Because revenue growth is the lifeblood of a growing company. It's like coffee for us humans, the much-needed energy that propels the business forward and the wind beneath the company's wings. So how do we evaluate this? Well, start by looking at the company's financial statements over the past few years. What we're hoping for is a consistent upward trend in revenues. It's like hoping for a consistent upward trend in your happiness. But remember that growth should be sustainable and manageable. It's like your diet plan, but actually achievable. An unusually high revenue growth can sometimes be a red flag indicating a possible bubble that could burst. So, always aim for steady and manageable growth. In essence, revenue growth is a key indicator of companies' potential for future profits. With a clear understanding of revenue growth, we're ready for step 3, or as I like to call it, the next level of this financial roller coaster. Now, it's time to check the company's profit margins. It's like checking your waistline after the holidays. Profit margins, folks, are a clear indicator of a company's financial health. It's like checking your pulse after running a marathon. They tell us how much profit the company makes for every dollar it generates in revenue. To check the company's profit margins, you'll want to consider both the gross margin and the net margin. It's like checking both your weight and your body fat percentage. The gross margin shows us how efficiently the company produces its goods or services, while the net margin reveals how well the company is managing its overall expenses. Keep your eyes peeled for consistent or increasing profit margins over time. It's like finally seeing progress in your fitness journey. This is a strong sign that the company is not only profitable, but also improving its operations and becoming more efficient. Remember, a company with healthy profit margins is a better position to invest in future growth. It's like being in a good position to invest in a new wardrobe after losing weight. Profit margins are key. Up next, step 4. Fourth, assess the company's debt. It's like assessing your own debt, but less personal and depressing. The first thing to understand, comparable to realizing the importance of not eating that extra slice of pizza, is the profound impact a company's debt can have on its overall financial health. It's not necessarily a bad thing for a company to have debt, but it's essential to comprehend the magnitude of this debt and how efficiently it is managed. Just like evaluating your ratio of healthy food to junk food, you need to assess the company's debt-to-equity ratio. This ratio can give you insight into how much debt the company has piled up compared to its equity. A high ratio might indicate that the company is fueling its growth with debt, which can be as risky as a diet entirely based on fast food. It's also important to consider the company's ability to service its debt, just like you would consider your ability to pay off credit card bill at the end of the month. You can gauge this by looking at the interest coverage ratio, which shows how conveniently the company can pay interest on its outstanding debt. Lastly, don't forget about the company's long-term debt. If a company has too much of it, it could struggle to meet its obligations in the future, just like you might struggle if you overspend with your credit card. Debt can make or break a company. Now let's move to step 5, or as I like to call it, next level of this financial horror game. Fifth, look at the price-to-earnings ratio. It's kind of like checking your bank balance after a shopping spree at the mall. Now, in the world of finance, the price-to-earnings ratio is a measure that investors use to gauge a company's market worth relative to its earnings. It's like evaluating your own worth based on the number of followers you have on Instagram. The PE ratio is computed by dividing the market value per share by the earnings per share. In simpler terms, it's like determining your value by dividing your total salary by the number of hours you've worked. A high PE ratio could suggest that a company's stock is overpriced, or it could mean that investors are expecting high growth rates in the future. It's kind of like high expectations could indicate you're overconfident or you have high potential. On the flip side, a low PE ratio could mean that the company is undervalued, or it could suggest that future growth expectations are not that impressive. This is similar to how low expectations might suggest you're underconfident or you have low potential. But remember, the PE ratio is merely one part of the big picture. It should be interpreted along with other financial metrics to get a full understanding of a company's financial well-being. The price-to-earnings ratio can offer a treasure trove of insights. Let's move on to step 6, or as I prefer to call it, the next terrifying level of this financial horror game. Finally, consider other key factors. It's like considering other key factors in your life, like your health, happiness, and whether or not you should get a dog. As we go deeper into the process of valuing growth stocks, it's crucial to realize that not just numbers, but other key factors can significantly affect a company's growth potential and, in turn, its stock value. Firstly, consider the company's competitive position. It's like considering your position in the social hierarchy. How does the company compare to its competitors? Does it have a unique selling proposition or a competitive edge that makes it stand out? A company with a strong competitive position is more likely to sustain its growth in long term, contributing to a higher stock value. Next, evaluate the industry outlook. It's like evaluating your outlook on life. The industry in which the company operates primed for growth? Are there emerging trends or technological advances that could uplift the industry's prospects? A positive industry outlook can bode well for a company's growth and, subsequently, its stock value. Thirdly, assess the quality of the company's management. It's like assessing the quality of relationships. A company is only as good as the people who run it. Does the management team have a proven track record? Are they innovative and adaptive to change? Competent, strong management can drive a company's growth and increase its stock value. Lastly, don't overlook potential risks. Every investment comes with some level of risk, and growth stocks are no exception. Consider factors such as market volatility, regulatory changes, and potential disruptions to the company's business model. Being aware of these risks can help you better assess a growth stock's potential value and decide whether it's a risk worth taking. In summary, when valuing a growth stock, don't just focus on the numbers. Take into account the company's competitive position, the industry outlook, the quality of the company's management, and potential risks. These factors can help you make an informed decision about a growth stock's value. It's like making an informed decision about your life choices. So those were the 10 steps to value a growth stock. It's like 10 steps to value your life but less existential. We started the journey with a quest to understand what growth stocks are, akin to understanding what happiness is in life. Then, we embarked on an evaluation of the company's earnings and profitability, much like how one examines personal income and spending habits. Our next phase of assessment involved a range of key factors. We gauged the company's revenue growth to check if it's broadening its market presence, much like evaluating health status in life. The company's profit margins were also scrutinized to ensure it's not merely earning, but doing so efficiently, akin to assessing our happiness levels. Then, we checked out the company's debt, a potential red flag for investors, and analogous to the relationships we nurture in life. The price-to-earnings ratio was another critical aspect we looked at to determine whether the stock is overpriced or underpriced, similar to evaluating our career trajectories. Lastly, we discussed other essential aspects, such as the company's competitive advantage, management quality, and future growth potential, just like how we ponder over our personal growth and future potential. In conclusion, these steps provide a comprehensive approach to valuing a growth stock. Remember, valuing a growth stock is as much an art as it is a science. It's like life, it's as much an art as it is a science. Before you go, don't forget to subscribe and hit the bell icon. Think of it as your nightly ritual, like brushing your teeth before you hit the sack. Now let's talk about the world of growth stocks. It's dynamic, full of opportunities, and just like life, it has its fair share of disappointments too. Subscribing and turning on notifications? Well, that's like always keeping your social media app notifications on. You'll stay updated with all the latest insights and strategies, ensuring you don't miss a single beat. Being the first to know about our new videos gives you a heads up, sort of like being the first one to get the latest gossip. It helps you stay ahead of the curve and make informed decisions. So consider that subscribe button as your secret source to staying ahead. Thank you for watching and stay tuned for more informative and darkly humorous videos like this one.